Good morning and welcome to R&R 2025. Today we are joined by Riyan Itani, founder and director of Global Branded Residences. Hello, Riyan.
Hi.
How are you doing?
Great, yeah. Stoked to be here today and looking forward to a busy and dynamic day.
So, Riyan, you've been tracking the branded residences market for many, many years. And by your own data, the sector has grown tremendously since 2014, and it is set to continue in that same vein. Talk to us about that. We want some figures.
Sure, okay. Well, yeah, I mean, the whole story has been about growth, really, from the outset, but recently, most importantly. So the sector has grown by over 100% in the past 10 years, over 50% in the past 5 years. And when we look forward, the sector is due to grow by almost double in the next 5 to 6 years. And that's a really exciting time when you think that this is almost 100-year-old industry that has been almost dormant for the majority of that time. And now the adoption of the model and the interest from the industry for branded residences has really picked up. Developers are understanding the economics and the net profit margin that's available from developing branded residences. And as a result, we're seeing this global adoption of the model and a huge amount of growth, particularly in emerging markets and in new markets, which is, for a relatively young industry, is just a very exciting prospect.
I mean, that level of growth and interest is great, and it makes me feel really good that I've decided to cover branded residences more in Hospitality Investor. But what do you think is driving all of this growth, and how do you see progressing, particularly in this area of the world, being Southern Europe?
Sure. I think what's driving the growth is primarily the economics. So when you develop branded residences, if we put it in really sort of basic or fundamental terms, you increase the cost of developing the building, and you increase that cost by somewhere in the region of sort of 10 to 20%. Your costs are increasing. But then your values, which are a much higher base compared to the costs, increase by, globally speaking, about 30 to 35%. So the differential between your cost increase and your value increase is so great that the net profit margin, I mean, we're doing studies at the moment and presented in Dubai last week and in London earlier this year, looking just at the net profit margin, that figure grows by anywhere between about 25 to, in Dubai, it was 70%. So, I don't know a developer in the world who doesn't want 70% more net profit margin after they've dealt with all of their costs and all of their revenues and everything. So that basic economics of it very much drives the industry. And then you have the two other major stakeholders, which are the brands or operators and the end buyers. And both of them benefit from this model as well. The developers are obviously making more money and doing fantastically well, but the operators are getting a huge amount of press coverage, a lot of contact in a different way to their customer base outside of their core business, whether that's hotels or fashion or automotive. And then it's really for those end buyers. And for them, it's about choosing a well-curated, well-managed, safe investment that they know is going to be looked after. And that's a real differentiator in kind of the modern world where we're all looking to make sure that our investments are safe. Here's a model that all but guarantees it.
So money, that's what makes it hot.
Yeah, and a bit of lifestyle, you can't get past the fact that this is a concept that is driven towards a certain curation of lifestyle. So whether that be you and your family or your business or your leisure pursuits or wellness is all part of the proposition.
And I mean, it's funny that you mentioned, non-hotel brands entering the space, because I was speaking to somebody from Colliers yesterday and he said, that's rubbish, it will not work. And I don't know, what are you seeing around that in terms of he was like, oh, if it's a Four Seasons, managed by Four Seasons, then that's that makes sense. But if it's, another non-hotel brand, say a Mercedes one, is no, forget that. What are you seeing around that?
It's such a polemic, it's such a sort of controversial conversation. And sometimes I wonder why, but so obviously with the majority of non-hotel brands, there isn't an element of management. It is about design, it's about lifestyle to a certain extent, but not so much about management, servicing, rental programs. And as a result, they get a very sort of bad press for being superficial. I've done plenty of deals with non-hoteliers and with hoteliers.
I've put you on the spot, haven't I?
I love talking about things like this because it's what really is driving the differentiation in our industry. You know, it's 80% hoteliers globally speaking, and that 20% is a diversified market of brands. So what I would say is that as industry professionals, as people who are working in the sector, it's easy to naysay and to say this is rubbish and it makes no sense. But realistically, what really comes down to is, are the purchasers interested in that brand? Is that a brand and a lifestyle and an identity that they associate with and will therefore invest in? And in the majority of cases, it is. They sell well, they sell for approximately the same premium as hotel brands. And as a result, one can't just dismiss it as something superficial. Now, having said that, the element of management and the element of servicing is really important to the concept of branded residences. It's one of the fundamentals. So it's really down to the developer who is partnering with a non-hotel brand to be able to deliver those services and deliver that lifestyle. And when that doesn't happen, yes, you get a potentially inferior product. So I would say that it's not so much about the brand, it's about the delivery, it's about the developer.
Thank you. So if you had to define a bankable branded residence in one sentence, what would you say? So what 3 ingredients show up again and again in successful schemes?
Okay, I can definitely define that. So the first thing would be the developer. This is all about delivery. It's all about the fact that this development is going to be delivered on time to a high specification with great servicing and management. And in many ways, that's why branded residences is such a powerful concept, because when you peel back the layers, the reality is that the brand goes through a lot of due diligence on the developer. They want to know about how they're going to fund the development. They want to understand that they are able to deliver the development, that they have the capacity to deliver at the quality that they're looking for and to their standards. So that imposition of standards and excellence on the developer translates to buyer confidence. And that's what in many ways drives the idea that, well, X brand wouldn't have put their name on this development if they didn't know that it was going to be delivered fantastically. So the developer is very important. The next element would be alignment. So making sure that brand makes sense for the location and makes sense for the buyer market. And when that alignment happens, sort of magic happens, which means that people really resonate with the brand. They're willing to invest in it, and they do so readily. When I say readily, in the sense of a higher sales velocity and performance in sales from a premium perspective. That was a lot more than one sentence, but I think that's.
And the third one, developer alignment. And
developer alignment, and then the idea that this lifestyle is wanted. So often we find, for example, luxury developments in non-luxury locations, or indeed non-luxury developments in luxury locations, and that can often be a sort of a recipe for disaster when you don't get that right alignment of brand and market. So demand is the critical thing, and that's what we do at my company at GBR. We help to make sure that those elements are de-risked, that the market is understood, that the product is fitting to the market, in order to make that magic happen.
Yeah. So one sentence: developer alignment
and buyers. Yep, exactly.
So what are the challenges and risks when it comes to branded resi development in this part of the world, and how are you seeing people dealing with those challenges?
Sure. So Europe in general and Southern Europe in particular has some constraints. So one of the key constraints in Europe is the size of our buildings. Our buildings are generally older, and as a result, they aren't as huge as, say, somewhere like Dubai or Miami. Yeah, like the average urban center building would be somewhere between 5,000 to 10,000 square meters. And at best you could do a standalone development without a hotel in that type of building. And that I know from conversations with my clients and with the operators is something that they're looking into. How do we make smaller buildings work for branded residences while still delivering that brand promise of servicing and management? So that's one of the major factors. I think in this day and age, you've got to take into account things like interest rates, the cost of financing, the cost of capital. So just building the capital stack in order to deliver and develop the project in the first instance is something that that can be a challenge. But the wonderful thing is, for all the reasons that I've just talked about, that certainty, that security, that delivery, investment is often more readily available for branded residences compared to non-branded residences, because that sort of seed investor or the funding partners know that we've got this wonderful brand who's going to manage and curate this lifestyle, which is going to translate into security and confidence for the buyers, and therefore we're going to sell well.
As we said, money, money, money.
Money, money, money.
Right, so we have talked about this, non-hotel branded residences entering the space and how you see them comparing and competing with hotel branded residences over the next few years. We have talked about that. So we can leave that alone. So looking ahead 5 to 10 years, do you see the branded residences segment morphing and evolving, and how?
Yeah, I mean, definitely evolving. I think, so looking forward, there's a couple of key trends that we're seeing. One of them is geographical diversification. And that means that whilst we have some of these huge centers like Miami, Dubai, New York that have in the hundreds of branded residences projects, what we're seeing is that new and emerging markets are now embracing the concept. And again, that's really exciting because for a relatively young industry, it's about awareness, it's about spreading the word, it's about the fact that it is a viable concept, not only in major urban centers, but also resort markets, also in emerging markets. And what's interesting is that in those emerging markets, that's actually where you see the highest returns, because you're comparing your branded residential product, which is beautifully designed, wonderfully managed, to relatively unsophisticated comparable product that doesn't have concierge and valet and a swimming pool and F&B and sky bars and all this kind of stuff.
Which is more difficult in markets that already have loads of these.
Exactly, that premium compresses because of the competition that you're comparing yourself to. So geographical diversification, very important trend. The other trend that I'm particularly passionate about is standalone development. So that's a residential project that doesn't have a hotel component and is just about residential. And in the final analysis, branded residences is a residential concept. It's not a hospitality concept. There are obviously all of the DNA of hospitality in there, but it is a residential concept. So standalone residences respond to a number of elements, which is exclusivity and privacy. So the owners don't have to compete for their use of their amenities and services with hotel guests and transient travelers. There are also downsides to that. The service charges tend to be higher in standalone developments.
But if you're buying a branded residence, do you even care?
Well, I think buyers almost always care. It's fascinating how the actual ticket price of the individual unit is sometimes a lot less sensitive compared to the service charge, the ongoing ownership. But also within the concept of branded residences, you have rental programs which help to monetize that investment and cover the costs that you're incurring on an annual basis. So standalone developments, and I've said it before and I'll say it again, you don't have to be a genius to realize that there are more residential buildings in the world than there are hotels, and there are more residential developers than there are hotel developers and hotel owners. And as a result, the standalone segment of the market is almost an inevitability in terms of how it will perform, and we're seeing that in the data. It is, in terms of the pipeline, is just about on par with integrated and co-located developments where you have a hotel in place.
This brings me to another question, which is the mid-scale branded residences. Do you see more of them popping up now? To your point about there are more residential buildings. What do you say about that?
That's definitely one of the other key trends. It's not quite as pronounced as some of the other trends. So statistically speaking, the luxury market makes up about 70% of all branded residences. And when we look at the pipeline so that's today, Then when we look at the pipeline of developments coming through, that percentage stays pretty constant, 69, 70%, looking into the future. Now, the small amount of loss of market share that the luxury segment has primarily goes towards upper upscale. So that's the segment just below luxury. But we do see when we cut the data by regions, we see that, for example, in Asia Pacific, there is a much higher prevalence in the pipeline of things like upper upscale and mid-scale brands. And that's fantastic. That's a really healthy trend, because what it means is that branded residences can be deployed in markets that wouldn't necessarily be able to sustain a luxury concept. And so we see places like, in particular, Vietnam, that have a very high percentage in their pipeline of upper upscale and mid-scale developments. And that's great. It's the democratization of the concept. It's bringing that lifestyle to people who wouldn't be able to afford necessarily a luxury solution.
And there you have it. I mean, the normal person might get
One day.
one day. But yes, that is all from me. Thank you so much, Riyan. Always a pleasure talking to you.
Pleasure to be here.
Thank you.
Take care.